Okay, guys, welcome. This is Unit 5 on finance. Okay, we're going to talk about accounting. Accounting is the process of collecting, recording, summarizing, reporting, and analyzing financial activities. Okay, accountants play an important role in investment decisions of the firm, acquiring new assets. Accountants produce financial statements that can affect a firm's ability to start or expand a business. Accounting is important internally in the company. Managers use these reports that accountants produce to make better decisions. So internally, it's also used externally by banks, financial institutions like insurance companies and venture capitalists that might want to take a equity position in a firm. And government, of course, government's interested, the FTC, making sure if it's a publicly held company that these accounting functions and auditing is done, and companies are transparent, so investors can be assured of that the data is accurate. So a lot of people use accounting information, so maybe some of you might want to become a CPA or certified public accountant. The first thing we need to learn is the accounting equation. And it's just assets equals liabilities plus owner's equity. Assets are the resources that business owns, or capital. And liabilities are the debts and obligations. It's borrowed money or an obligation to pay, contractual agreements, payroll, things that they haven't payroll to be paid, would all be obligations that they'd have. That's the owner's liability. And then if all the owner's equity or all the assets were sold to pay off the liabilities, what would be left would be owner's equity. Excuse me. So this accounting equation is the equation that's used to utilize and to form the balance sheet, which is our next slide. A balance sheet is a firm's financial position on a particular date. It was different yesterday, it'll be different tomorrow. It's like a picture. A balance sheet is made up of current assets, fixed assets, current liabilities, long-term liabilities, and owner's equity. Current liabilities and current assets mean that that's under a year, under 12 months. And long-term liabilities would be over a year. So current is less than a year, and long-term liabilities would be over a year. The next statement that accounts responsible for is the income statement. And unlike a balance sheet that's just on that particular day, an income statement is over a period of time. A lot of times they're quarterly or annually done. So each quarter a financial statement would be produced. But actually with today's accounting software, you could get a income statement and balance sheet produced on a daily basis. All this with Peachtree and QuickBooks, the accounting software available today, gives managers a lot more financial data, access to these things. An income statement is revenues minus cost of goods sold, selling expense, which is often a variable cost, and then general and administrative expenses, which are generally a fixed cost. And what is left would be either a net income or a net loss. So income statement produces a financial record of a firm's revenues, expenses, and profit over a period of time, or loss, profit or loss. When we say we're making a profit, we're in the black. When we're in a loss position, we say we're in the red. Is it okay to ever be in a losing, have a losing financial statement that's in the red? And the answer to that is yes, especially for business startups. Often you need to be planning, at least for a short period of time, till you get your business established, to lose money. Very few things can make money right off the bat. It's not okay never to make any profit. You have to realize a profit, but you need to be capitalized enough often. Like if you're going to start up a restaurant, it takes a time to build clientele and build your restaurant. So often, in fact, restaurants often fail because they're not given a chance to build their clientele. They're undercapitalized. So then we have what's real critical to a small business person is the cash flow statement. And this is a statement that's developed to determine if you can meet your current obligations. So it's a summary of all the monies flowing into and out of a firm. And where does cash come from? It comes from operating activities, sales. It comes from investment activities, people buying stock in your company, or flows from financing activities, either borrowing monies from financial institutions or issuing bonds. So those are the three sources of money for your cash flow statement. Well, what an entrepreneur needs to do is to hit the break-even point before they go bust. So this is one of the critical formulas that you need to learn. And I actually have you use this formula in our case this unit. We have the Smith Foods case, and you're going to calculate the break-even point for that business. We have break-even point equals total fixed cost minus price over variable cost. Fixed costs do not change with level of output, so no matter how many sales we make, that fixed cost does not change. Examples of fixed cost would be a leasehold, often, or the cost of goods sold would be a fixed, the cost of goods sold is a variable cost because it's directly related to the output. No matter how, so if you sell so many units, if you're a retailer, you have to buy so many units. So the fixed cost would be your administrative cost, the CEO's salary, things like that. Variable cost would be sales commissions, would be things that are related directly to the changes in output. And then hopefully we'll set price to maximize profit. So you take the price and subtract variable costs, and the sum you get there will be the contribution margin. And you divide that sum or the contribution margin into the fixed cost, and you get how many units you will have to sell to neither realize a profit nor suffer a loss. And this is a critical formula because the object here is to break even before you go bust. And this comes to a nice slide, the iceberg principle. This is the idea that much good information is hidden in summary data. Since total sales may be large and company activities varied, problems in one area may hide below the surface. Averaging and summarizing data are helpful, but make sure these summaries don't hide more than they reveal. Okay, some examples here might be SeaWorld. And SeaWorld at one time had 4 locations. They had one here in Ohio, a location in Florida, one in Texas, and one in California. Well, what did the SeaWorlds in Texas, Florida, and California have in common? Well, they could be open 360 days a year. Here in Ohio, they really couldn't be. So in the other locations, they had a return on investment of 12 and 18% and 8%. But here in Ohio, they were just hitting that break-even point. So when they sold their Ohio SeaWorld, they were actually able to put those funds to better uses, were actually able to raise the rate of return for their shareholders. So, but if you looked at all their sales together, they had like a 7% rate of return. But when they were able to sell their Ohio SeaWorld, they were able to do much better. Well, in your text, there's a lot of different formulas for ratio analysis and what they're used for. But for my purposes here in this BUS 101 course, I just want you to realize why ratio analysis is important, how it helps managers interpret data. Because it helps them make comparisons. What does General Motors and Nissan Motors have in common? You guessed it, they both make cars. Well, General Motors is 10, 12 times as big as Nissan Motors. If you just had the raw data, the statements, it would be very difficult to actually make comparisons. But when you put it in ratio analysis, you can actually make comparisons of financial performance. And the same thing over your own firm over a period of time, especially if you're like a fast-growing company, like Apple Computers. 10 years ago it was selling for $80, $100 a share. Now it's $600 a share. Well, if you're growing that fast, it's very, very difficult to actually do that trend analysis. But when you put things in ratios, it actually helps you compare apples and apples instead of apples and oranges. Okay, now one of my favorite topics is money and how the Federal Reserve System controls the money supply, monetary policy. Well, the Fed has 3 ways to regulate the money supply. They can regulate the reserve requirement, and this is the percentage of deposits a bank must retain in its own vaults or on deposit with the Fed, or the Federal Reserve Bank. The Federal Reserve Bank is the banker's bank. Okay, it's where your local bank gets their money, and the chairman of the Federal Reserve Bank is Ben Bernanke, and Fed policies and are as far as the economic is just almost as important as the president here of the United States. Because they're in charge of regulating the money supply. The second way they do it is by regulating the discount rate. This is the interest rate that's charged to member banks. Again, the Fed is the banker's bank, and they charge them an interest rate. And then, of course, the banks mark up their interest rates and loan them to businesses and individuals. And then the last way that this money is controlled through the selling and buying of U.S. Treasuries and financial instruments. It's called open market operations. Now, regulating the reserve requirement, that is not moved very often because a small percentage of the reserve requirement can make a huge difference in the money supply. So they don't move that very often. Regulating a discount rate, that the Fed will actually have meetings. You see those on the news. They report that the Fed met and they decided to either raise interest rates or lower interest rates or keep them the same. And they meet generally about every 30 days, or they can have special meetings. But they meet about every 30 days. Your open market operations is happening 24/7, 365 days a year. And you can get into some real complications there. I think your text talks a little bit about M1 and M2 and M3 money supply. But you can that gets pretty complicated. But you know that they're doing that all the time to regulate the money supply. Well, what are the lending standards? What do banks look at to borrow, to extend credit to both individuals and to businesses? Well, creditworthiness of an individual. Well, let's talk a little bit about how we want to use credit to increase wealth as an individual. There's a couple things you can do as an individual to use credit to actually increase your wealth. One of the things you can use credit for, you're doing it right now, possibly in college. You're borrowing money, especially government subsidized rates at low interest rates, and you're financing your education. You're investing in yourself. Another way you can increase your wealth and opportunity is to borrow money on a mortgage to buy a home. In fact, the difference between a working poor and the middle class here in America is often home ownership. If the working poor rent and the middle class are building equity in a home. In fact, most middle class Americans, much of their assets are actually in their home, equity in their home. Well, how are people going to qualify? How will you qualify for a mortgage? Well, the first two things here are critical. The borrower's credit history. This is how well you pay your bills on time, well, let's ask you a question. Often you will get a car loan, and a car loan is much easier to get because often the car dealer is assisting you in getting that loan. So you don't have to have near the credit standing to buy a car as you do a mortgage. So you get these loans and you pay them back on time and you build up a good character. But let's say that you haven't. Let's say you get this car loan and you get a coupon book for this loan, and the often the car payment is due on the 5th or on the 1st, but on the 5th or the 7th, there's a $20 or $25 late fee. So as long as it's paid between the 1st and the 7th, you don't pay a late fee. You're not late, right? Thank you for playing. Yes, it's due on the 1st, and if it's not paid, if it's in that grace period, it shows up on your credit history as 1 day, 30 days late. So it's real critical to get your payments in on time. And one of the things you can do now is this is 2012, your coupon books is a silly way to be doing banking because the U.S. Postal Service can take a week to get something across town. And you're better to do this all electronically with electronic banking. In fact, sometimes they'll give you 1/4% or 0.5% better interest rate if you agree to have your payment on the 1st of the month deducted right from your checking account. But I know what you're saying. Some of you are saying, Mr. Marshall, that's fine for you. You've got money in your checking account. What if you're a poor college student like me? I'm busted, disgusted, and can't be trusted. What if I don't have money in my checking account at the first of the month? My check's going to bounce. And that's a worry, because if you bounce checks, that's very bad on your character. In fact, it's very costly. It can cost a couple $100 by the time you pay all the fees on a bounce check, and it looks very bad on your credit history. So don't bounce checks. One of the things that you should do is have a line of credit behind your checking account called a overdraft account. I mean, so that it's a line of credit. So if you happen to go under, your checks won't bounce. They'll be given. You'll access this line of credit, and this overdraft protection is what you want to get. So if you keep under $2,500 in your checking account, you need to get a $2,500 line of credit, or behind your checking account. So if you access this loan, you're actually borrowing money on by writing this check, overdrafting, but you're charged a fee and some interest to do that, but it's a lot less than the overdraft fees that you pay, and you're protecting your credit. So I would actually absolutely have my car payments automatically deducted from my checking account, and have this overdraft protection if you don't carry a balance high enough, and that will help protect your character and your credit history. Well, you're saying, well, Mr. Marshall, how do I get established? I don't have any credit, or I've already messed it up. What can I do? Well, you can go to a full-service bank and put $1,000 or $2,000 in the bank account and borrow that money back, or get a secured credit card and then use the credit card and pay the balance on time. They have to give you your money back, and it's a secured if you have that money, and if you'll start establishing credit or reestablishing credit. Well, the second one that the bankers look at for mortgage is capacity. Generally, they'll take monthly income. If you're a couple, your husband and wife's monthly income, and 35% of your monthly income you can use in installment debts. So, and you can choose how you want to use your capacity. Your borrowed money is 35% of your gross income. So you can choose to use that for car payments, credit card payments, or house payments. I would tell you that a mortgage payment, the more money you can put toward that, in a home, your mortgage payment, the interest is tax deductible, and you're building equity. And when you rent, all you're getting at the end is a rent receipt. You're building no value. So I would use your capacity to purchase a home. The last three here aren't as important to young people. Capital, your borrower's assets or net worth. Well, if you're in your 20s, just out of college, you're not expected to have a lot of net worth. But if you're in your 50s and you don't have any assets built up, you don't have a 401k or a home or assets in your house, they're going to say that you're not a very responsible person. Collateral would be the real estate or the personal property pledged as security for a loan. And then conditions. Just our last slide on how the money supply is. If the Fed is actually making it easier for bankers to loan money to individuals and businesses by making interest rates low and making money available, that's part of the conditions. So how the economy is and how your individual economy is. All those 5 things are the 5 C's of credit worthiness. But the first 2 are the most important. Well, businesses also borrow money and to actually increase their rate of return for individuals. So individuals can use credit to buy homes and to finance their education and increase their financial standing and wealth. Financial managers can also borrow money to increase the business's rate of return to their shareholders. A financial manager is the individual in the firm responsible for developing and implementing the firm's financial plan and for determining the most appropriate sources and uses of funds. And this is the critical part here. A financial manager seeks to balance risk with return. So the balance is the key thing. If you're seeking a very high return, you then have to accept a higher risk. If you want to lower your risk, you're generally going to have to accept a lower rate of return. So the key for the financial manager is to balance risk with returns. Where do firms get money? Well, from our operations or from sales revenue, and from borrowing money obtained through banks or through issuing bonds. Equity capital provides funds that the owner's additional contribution if it's a closely held firm. We can issue stock to the general public. We can raise contributions from venture capitalists. We'll take an equity position in our firm. Or the proceeds of the sale of assets of underutilized capital. This is what SeaWorld did. They sold their Ohio location and they put that to better uses. So how financial managers can increase the rate of return is through leverage. And leverage is a technique to increase the rate of return on investment by financing it with borrowed funds. As long as earnings exceed interest payments on borrowed funds, financial leverage will occur, allowing the firm to increase the rate of return on its shareholders' investment. So the key is to balance risk with return here by using credit and leveraging part of your business and for your funds. You can raise the rate of return for your shareholders. Well, when you're issuing stock, common stock, that is actually you're a part owner of the company. You're a shareholder. And shareholders expect to receive payments in the form of dividends and capital gains from the increase in the value of their stock. Okay. A preferred stock is a kind of an in-between position of a stock and a bond. The dividends almost act like a bond in that if a firm doesn't pay the dividend on their preferred stock, they have to be near or in bankruptcy before they'd ever not pay their preferred shareholders. Often there's a conversion provision in there where at a certain amount you're guaranteed this interest rate, but if the company does grow, the preferred shareholders can gain some of that too, not as much as the common shareholders. And then the bonds is not a stock at all. This is the no ownership position. This is a certificate of indebtedness, and so you can buy government bonds and U.S. Treasury bonds, anything with the full faith and credit of the United States government is the safest investments, and other government maybe not as safe. If you loan California money now, governments don't go bankrupt like corporations do, but sometimes governments don't pay. So you have to weigh the risk with return, right? And so if the state of California, which is really in really high debt, they're going to have to pay higher interest rates, which even makes things worse for them. So bondholders are creditors, not owners. Well, as a investor, there's about 4 basic strategies or things that you want to accomplish with objectives. Speculation. This is hope for a very large return in a short period of time. This is acting on merger rumors, penny stocks, taking a chance on something. On the other extreme would be the safety, which is to preserve capital, purchase very high quality bonds, preferred stocks, anything FDIC, Federal Deposit Insurance Corporation, savings accounts, anything you put in FDIC, in insurance, savings account or checking account under $250,000 is insured. Those are the safest investments. So you got the two extremes where you should, if you're in your 20s now and you're just getting out of college and you get your first really good job as a manager in business, you should start to invest, right? How many people think that Social Security will be here for somebody in their 20s now? More people believe than the Easter Bunny. So you need to start early with the power of multiplication and compounding. You should be putting 5 to 10% of your income into savings vehicles. Well, probably the best savings vehicle of all times is the 401k when your employer does some matching. Okay, you want to take advantage of all the matching of your new employer. Let's say that they will match 50% up to $3,000 that you invest. Well, 50% of $3,000 is $1,500. If you don't invest $3,000 into their 401k, then you will never see that $1,500. And there's no investment that can guarantee you 50% return right from the get-go. So the 401k, and you should invest in mutual funds with a growth, when you're in your 20s, you might want to take a shot at something, put 5 or 10% of your money in something pretty speculative. Okay, in growth, you want to put 70% of your money in growth. Income in your 20s, you don't need to do anything there. Safety, you need to put 3 months income and expenses into an emergency account, okay, in safety. And but then as life goes on, and it's amazing how fast it will, you're in your 20s now, you'll go to sleep, and just like Rip Van Winkle, you'll wake up and you'll be 40. It happens that fast. So when you're in your 40s now, you need to do different things. You don't need to do any speculation now. And once in a while, speculation will pay off. If I kick myself in the head when in the 70s, if I would have put $1,000 in a little-known company in Bentonville, Arkansas, Walmart, in the 70s, I wouldn't be your professor today, right? I would be on an island in Waikiki, drinking an adult beverage. So, and my father had the same thing. He was said, boy, if I'd have put $1,000 in IBM in the 50s, But unfortunately, for every IBM and for every Apple computer or Walmart, there's 100 that don't work out so well. Okay, so but when you're young, you can do something kind of speculative. Maybe you'll hit the big one. But most of the money you want to put in growth. But as you get older, you're in your 40s and 50s, you want to stop that growth and tap that down a little bit. Maybe go down to 50% or so, and then put 25% in income and 25% in safety. There's some crossover there. But then as you go on in life, you're near retirement, you're in your late 50s, early 60s, you want to go maybe a third growth, a third income, and a third safety. So you want to change over time as you age, you want to become more conservative in your investment strategy. The reason is 2008. When you're in your 20s, if you have a 2008, you can withstand it, you can catch back up. But if you're 50 and you have a 2008, you need to be in more conservative investments. Well, the best vehicle, unless you're a qualified investor, and a qualified investor doesn't mean you have to take a course in investing. It means that you have $500,000 or more in investable funds. Unless you're a qualified investor, unless you have $500,000, you shouldn't be involved in individual stocks at all, in my opinion. You should buy mutual funds with, in fact, you can buy mutual funds with any of those four objectives. You can buy mutual funds that are a little more speculative. This would be sector funds or international funds. I have some mutual funds and international funds that have done very well. India and China have really been booming, and those are more speculative mutual funds, but they've been very good. Most of your funds can be either large cap or mid cap or small cap growth funds. And mutual funds are a pool of people's money managed by trained, experienced professionals. And what you want to do is go with these mutual funds because you gain diversification. If you just have a few $1,000s to invest at a time, or a few $1,000s, well, it's very difficult to get diversification. If you just have a handful of stocks, and one of those stocks happens to be Enron, well, you can take a huge loss. Well, and actually Enron was widely held by mutual funds. But if they have 2 or 3% of their money in Enron, well, they have 96%, 97% of the rest of their portfolio that's doing very well, even though they lost. But if you had 25 or 30 or 40, 50% of your money in one stock in Enron, it happened to be one that was fraud and went bankrupt, well, you really need to gain that diversification. And having these no-load mutual funds. I personally like Fidelity and Vanguard because they're low-fee and no-load funds, family of funds that do very well. Well, let's talk a little bit now. Our next slide is on risk management. And both firms, companies, and individuals have risk that they need to manage. And the risk management is the process of evaluating risk faced by firms and individuals and then minimizing the cost involved in that risk. Okay, well, There's four methods that we can use to manage risk. One thing we could do is avoid the investment at all, or avoid the thing. Cities right now, all over the country, are closing their parks because kids are injuring themselves, falling off the monkey bars, breaking their arms, and obviously it's the city's fault that the kid fell off the monkey bar, and we're in a very litigious country now where the parents will sue, and the city just can't afford to do that. Other things they could do is a reduction strategy. Okay, out here at Riverside Park in Findlay, they have a pool. They have a really nice river where they rent the boats and the pool. They have Red Cross trained lifeguards to do the pool. They've put little pieces of rubber under the swings and the monkey bars and things, and those are all reduction strategies. The city of Findlay's actually looked at shifting the risk to an insurer, but the premiums are so high to have their park system insured that they've just decided to assume the risk. They've tried some reduction strategies, and they're going to, because the insurance premiums are so high, that's why some of the parks, it's hard to be a kid today if your park is closed. Well, what's a key risk of an individual? And one of the risk would be premature death, and we can talk about when we need life insurance and shift that risk of the premature death to an insurer. So let's talk about that. There's term life insurance, whole life, and universal life. Whole life and universal life is using life insurance as an investment tool. Well, I really prefer to use mutual funds and dollar cost averaging, meaning that every 2 weeks you put your check into your mutual fund, over using life insurance, because in every life a little rain must fall. 51% of you are going to get a divorce, and that's a financial disaster. Some of you are going to be laid off. Others are going to get in a car accident. Nobody gets out of life unscathed. Bad things are going to happen. Okay? If you've got this whole life or universal life insurance contracts, you sign a contract that you agree to pay this premium, and if you get in one of these circumstances, you're laid off, going through a divorce, problems, you can't make that premium, there's forfeiture provisions. In other words, insurance companies are going to keep part of your money. Okay, and one thing I've learned about insurance companies is they love to take the premiums, but they really don't like to pay the claims, right? They hold on to the claims like with a death grip. Okay, so I really don't like whole life or universal life, and I don't like insurance annuities as an investment. I like mutual funds because you get the statement and your name's on it. Okay, it's your money. If you have to stop making your contributions to your 401k or your IRA, it's still your money. Okay, or even if you're under 59 and a half, you can withdraw some money. You have to pay a 10% penalty, a tax penalty, and pay the taxes on it, but it's your money. So there's tax implications, but those are your funds that you've saved. Insurance, using that as an investment tool, I don't think really is your best service. And because the way I look at life insurance, a term policy provides you this protection when you need it. And when do you need life insurance? Well, you're in your 20s, you're unmarried, you're out getting your first job. What's your largest expense? Most people, their car payment. Okay, how is somebody in their 20s likely to die? Well, they do get diseases and things once in a while, but the most likely way is you're going to wrap your car around a tree. Well, if you've got an auto insurance policy and you total your car, that's going to pay the loan. Your car insurance policy is going to pay your car loan. So what's your exposure? Well, it's going to be $6,000–7,000 to bury you. Well, hopefully grandparents and parents and brothers and sisters, families can get together and come up with that money to pay the funeral expenses. That's not a large exposure. Okay? At the other end of life, you're in your 60s, late 50s, early 60s. Your house is paid for now. You're an empty nester. You've put your 2.2 kids through college. Do you need life insurance at this point? I don't think so. Because one exception to that, if you've done very well in life, if you have more than $3 million in savings, and then you may need some life insurance because life insurance is not taxable, and you may need to have that money to pay your inheritance taxes. Okay, and but if you're just a middle class person, you have other assets, these mutual funds and things. At that point, you don't. So when do you need life insurance? Well, I talked about buying this home. You've got a $200,000 mortgage, and it takes both husband and wife to make that mortgage. And if one of the spouses prematurely dies, now you've got a problem. Not only your kids have lost a parent, but now maybe they have to move out of their home that they've known, move out, change schools, and you have to sell your home in an emergency basis, not get as much for it. That's when you really need life insurance. And you can get a term life insurance policy, $500,000 worth of protection, $35–40 a month. This is what you need during this period of time when you've got this large mortgage obligation and you've got young children that you need to put through school. And well, let me tell you a type of life insurance never to buy, and that would be mortgage insurance. Because what happens there, you're going to go to buy your first home and you're going to be nervous. You've never spent $200,000 in your life. You're going to be shaken like a leaf. You're going to go to this title insurance company, and there's going to be 3 or 4 people in this room, and you've never met any of them. Well, maybe you've met your real estate agent. But they're going to have a stack of papers for you to sign and go through. And somebody in that room is going to come up with a wonderful idea that, well, what happens if one of you dies? Can you make this payment? Well, no, you can't. You needed both incomes to make the payment. Well, if we're only an extra $125 a month, we can protect both of you. And you're going to say, maybe okay. That's the wrong thing, because you're not buying life insurance to protect you. You're buying mortgage insurance to protect the lender. If you die, the mortgage is paid. But a couple reasons not to buy. Do you have any time to check and comparison shop when you're in this room with the title company? No. So the premiums are going to be much higher for what you get. And then as you're amortizing the loan, Okay, in other words, you're paying your loan off over the years, and so the payout gets less. Okay, so you're paying the same premium, and and if one of you die, you don't have their payout is less, and then you have no flexibility. What if you've got a child in college and you need to pay tuition, or there's other things that may be not in your best interest to pay the loan off completely? Well, the surviving spouse has got no choice on a mortgage insurance. It just covers the mortgage insurance. So um, this would be why I favor a term life insurance policy that you buy on your own individually and you shop around, and you get a lot more insurance for your dollar doing that than you can on mortgage insurance. All right, well, here's my last slide. How many people here want to hit the lottery? Good. You know what? You already have in a lot of ways. America's 4% of the world's population, about 350 million people. Yet we produce 25% of the world's GDP. You hit the lottery by just being in that 4%, being born American. As long as you don't do stupid things, like get involved in drugs and alcohol, drop out of school, you should, and do these basic things, you should make it into the middle class and do very well in life. Well, the first thing up here is you'll be surprised how many people don't know their income and expenses. They kind of go around life with their finger up their nose. Don't be that person. Know your income and expenses and save a little money. Do not overspend on credit cards. Okay, remember I said there's good uses of money. Would be getting a home loan and financing your education, and those are good uses of credit. Going to Victoria's Secret and charging underwear on your credit card and paying 22% interest on that credit card is a dumb use of credit. Okay, but in our modern society, you need credit cards. You need them to buy things online, to rent a hotel room, to rent a car. I don't think that you could even rent a car without a credit card. So they're convenience that you need. The average American has 7 credit cards. You don't need 7 credit cards. In my view, you need 2 credit cards from 2 different banks, 1 Visa and 1 MasterCard. You need to pay the monthly balances off. You pay no financial charges. In fact, it'll help you with your budgeting. If you use your credit card, as long as you pay the balances, you can keep track. If you buy groceries and gas, in fact, the pay at the pump, I haven't gone in and paid in a long time. I just use my credit card. Well, at the end of the month, you can calculate, well, how much have I spent on gas? How much have I spent on groceries? And that's a convenience that actually helps you with your budgeting. Again, have a rainy day funds. Have 3 months income and expenses in just a FDIC savings account. This means when you need new brakes for your car or new tires for your car, you've got some money to pay for those unusual expenses. Okay, 5 to 10% of your wages in a good no-load mutual fund taken right out of your check so you don't see it. Otherwise, you have a hole in your pocket if you get the money. If you never see it, it's taken right out of your check. Take advantage of employer-sponsored 401k, individual IRAs or Roth IRAs. I haven't gotten into what the difference is there. Traditional IRA, you can take off your taxes now, but then when you retire and start withdrawing from the money, you have to pay taxes. The Roth IRA, the advantage there is you pay the taxes now, and all the interest and dividends and growth that you make in your funds, you don't pay taxes on when you withdraw. you don't pay any taxes. So the Roth IRA is a really good vehicle. Purchase a home. Mortgages build equity, and rent only leaves you with rent receipts. Okay, so that's a critical thing. And find something that you like to do, that's a hobby. That I know some people that do this quilting, and they enjoy it. And believe it or not, they go to these craft shows, and some of these quilts sell for $1,500, $2,000. And I know you're supposed to report that to the IRS, but somehow you might forget. And it's cash. So that's kind of good money. So those are some, this is not an exhaustive list. There may be other things, but these are some simple things that you can do and secure your financial future.